So we are told here, my good students, that 𝗲𝗵𝘆 Limited debt equity ratio by market value is 2:5. The corporate debt, which is assumed to yield a return similar to treasury bills, have a rate of 10% before tax. So basically, when they tell us that it is treasury bills, we know that that is another language of them telling us that that is the risk-free rate of return. So risk-free rate of return has been provided. The beta value of the company's equity is currently 1:1. The average return on stock market equity are 15%. The company is now proposing to invest in a project which would involve diversification into a new industry. The following information is available relating to this industry. Average beta coefficient of equity capital is 1.6. And then number 2, we have average debt equity ratio in the industry is 1.2 by market value. And then the corporation tax rate is 30%. Very slowly, I would want us to remind ourselves of very, very few things here. We have what we call the Hamada's model. Every student must go to this exam knowing this Hamada's model. And we know how the Hamada's model looks like. Beta equity over a levered firm will always be equal to beta equity over unlevered firm into 1 plus debt over equity, but adjusted for what year? Adjusted for tax. Adjusted for tax. Adjusted for what year? For taxation. Adjusted for taxation. Now then we have here what we call beta equity over a levered firm. So basically this is a beta equity or the geared beta. So what you're supposed to know, ladies and gentlemen, is that geared beta has two components. Geared beta has how many components? 2 of them. Number 1, we have what we call business risk. And then number 2, we have in this case here the financial risk. So anytime we talk about geared beta or beta equity levered, we are supposed to know that geared beta has 2 components. Which components are these? Number 1, we have business risk. And then number 2, we have what we call financial risk. Generally, beta is a measure of risk. Is a measure of what here? Risk. Beta is a measure of risk. I think my light is too bright. You guys can't see my board very well. Just give me 1 second. 1 second. I know that will be much better, isn't it? Is there somebody who can confirm that this is much better when it's like that? Yes. So then we have got 2 components here for the geared beta. Geared beta has got what we call business risk. And then number 2, we have what we call financial risk. Now from there, if this is correct, then I would want us to go and look at this beta equity unlevered. So this beta equity unlevered, you write it in full. Beta equity unlevered. Beta equity unlevered is also known as assets beta. Is also known as assets who? Is also known as assets beta. In this case, ladies and gentlemen, this assets beta has only business risk within it. Assets beta captures the business risk. The business risk only. It doesn't have any financial financial risk within it. You know, financial risk means debt. When it's unlevered, there's no debt. There's no debt. When it's levered, it has both components, business risk and the debt component, the financial risk component. And ourselves, in this case here, we need to know how to convert from one beta to the other. And in this case, the connection between the two, is basically a model that we call Hamada's model. Ladies and gentlemen, please listen. Because this has got two components, beta equity levered has got two components, it must always be bigger than beta equity unlevered. So you're saying that beta equity levered must always be more than beta equity unlevered, must always be more than beta equity unlevered. Always. Now, ladies and gentlemen, we normally use this Hamada's model in most cases for those organizations that would want to diversify operations. So, for example, if RCM today wanted to go into agriculture, and by the way, this semester we have gone to agriculture, we are doing a sheep breeding. So if you want to go to a new industry, we are a college and we want to go to a new industry, then Hamada's model will be used. Hamada's model will be used in this case here to analyze what we call risks, There is no way you will go to a CASNEB's AFM exam without knowing how to apply Hamada's model, because organizations are expanding, organizations are diversifying into new environments. We need to know how to analyze the risk. And this is how we shall be doing it using this question of August 2023. Using this question of August 2022, sorry, I rubbed it. It's August 2022, question number 2A. So we are told here, Libe Limited, debt equity ratio by market value is 2:5. The corporate debt, which is assumed to yield a return similar to treasury bills, has a rate of 10% before tax. Very good. The beta value of the company's equity is currently 1:1. The average returns on stock market equity are 15%. 15%. All right. We did it yesterday, but let us just repeat it. We are told that the company is now proposing to invest in a project which would involve diversification into a new industry. So we are going into a new industry. The following information is available relating to this industry. Average beta coefficient of equity beta is 1.6. Average debt equity ratio in the industry is 1:2 by market value. The corporation rate tax is 30%. So they want us to give them the suitable cost of capital, which will be the WACC. They want us to give them the WACC there. So this is very good. So we are going to a new industry. So if we are going to a new industry, what do we do? Like these football matches, we have to play away first. You don't start by playing from home. You play away. That's how I always make my students understand. So we're going to do an away match. What do you mean, Mwalimu, with this? Away match, you go to the new industry first. Go to the new industry. So new industry means what? That you use the new beta given, and the new what here, and the new debt to equity ratio. New debt to equity ratio. Everything should be new. You should start with the new industry. So in this case here, we are playing away. I hope ladies will be able to understand this. We have got what we call away match and home match. So always you start with the away match. So away means what? You go first of all the new industry and do your research there. Do risk analysis there. Now, ladies and gentlemen, remember, in this case here, this new industry, new beta, and the new everything new. You are going to give us beta equity. Use Hamada's model. So then we use Hamada's model to connect the two industries. Hamada's model. So under Hamada's model, we know here that beta equity of a levered organization will be equal to beta equity of an unlevered company into 1 plus debt over equity into 1 minus tax, like that. 1 minus tax. Very important model. but you must appreciate all of us. So I want everything new. So using this, ladies and gentlemen, information here, what I would want us to do here is to use Hamada's model to get, so use Hamada's model, use the model to get 𝗲𝗀 of new industry, Use Hamada's model to get 𝗲𝗀 of the new industry. So is there somebody who is able to see the beta of the new company? Is there anybody who is able to see the beta value of the new industry? I mean, beta of the new industry. I would want to move slowly because these questions are very common. Beta of the new company. Is there somebody who is able to see beta of the new company or of the new industry? They'll use either word new company or new industry. Remember here, we are playing away match in the new industry. Thank you very much. So of course that will be beta equity of 𝗲𝗀, which is 1.6. New farm. So beta equity of the new industry. So this is beta equity of the new industry. Why am I calling it 𝗲𝗀? It's because I know that this new industry has debt. So you can see in the question, ladies and gentlemen, what they have told us in this question is that if you read the last paragraph, the following information is available relating to this new industry. Average beta coefficient of equity capital. Beta coefficient of equity capital is 1.6. I don't have a problem with that. Look at note 2. The average debt to equity ratio in the industry is 1:2. So you can see this new industry has got debt component. So meaning that this is beta equity, but over a levered organization. Over a levered, levered means what? Your debt component is there. Now from there, come and give me this 𝗲𝗀 for the new industry. This is what we do not know. Remember we said here, it is new industry, it's a new beta you have given me, and of course it is new debt to equity ratio. So do we have the debt to equity ratio here for the new industry? For the new industry, remember everything is for the new industry. Everything is for the new industry. So for the new industry, do we have debt to equity? Do we have debt to equity? So debt to equity, if you look at very well, note number 2, they've told us debt to equity is 1:2. But now, JC, you write it like this, 1/2, because debt is 1 and equity is what here? 2. So up to here, I don't know whether we are really following. Up to here, are we following? Up to here, are we following? Are we following up to here? All right, great. And this question here, they have given us the rate of tax. Tax is 0.3. Therefore, 1 minus t will be 1 minus 0.3, which gives me 0.7, which gives me 0.7 like that. So now I would want you guys to plug in and give me beta equity of this levered organization. I'm giving you exactly 1 minute. Now plug in everything. Now you have everything. Give me this beta equity of unlevered farm. I'm giving you exactly 1 minute. So Rosemary has a figure there. Rosemary has a figure there. Nancy is getting 2.16. I don't know who is telling me the truth. But thank you very much for trying. Paul is giving me 2.16. Thank you very much for you guys trying. I like students who try like that. I like students who try. So let's try this together. Remember now, Bell is the one that is 1.6. Which equals 𝗲𝗀 that we do not know. We don't know 𝗲𝗀. We have here 1 plus debt to equity. So this is 1/2 times this 1 minus tax that we've gotten there, which is 0.7. Please don't put brackets. This one is not being affected by this 0.7. No. So then move slowly. This will be 1.6 equals 𝗲𝗀 into, somebody should be able to give me this answer in brackets here. I'll be able to get my calculator. I always like using my calculator. So I always like using my calculator. So then we have here 1 plus 1 divided by 2 times 0.7, which then at the end of the day will give me what figure? Somebody here, 1.35. Thank you very much. 1.35 here. 1.35. So meaning that the 𝗲 then will be equal to 1.6 divided by 1.35 like that. So it will be 1.6 divide this by 1.35 like that, which in this case here gives me what here? 1.6. What did I do? 1.6. I hope this is 1.6. So we have here 1.6 divided by 1.35. I'm getting 𝗲 of 1.185 like that. Is there somebody who is getting this figure? I saw you guys getting 2 point something. I don't know how you're getting it. This 1.185 is the one that is correct. Can I get to know the guys who are getting 2 point something? Are you able to identify your mistake? Are you able to identify your mistake? Are you able to identify your mistake? Because that is very, very important. Are you able to identify your mistake? That is very important. Ladies and gentlemen, this is a away from home, an away match. So next step, after you are done with this away match, now you come to the home. Now you come home here. The whole figure, okay. Now you come home. Now we have everything. Now let's come home now. Hamada's model, if you understand this very well, then I'm done. I'm done with this concept here. So then come here and take us straight away to home now. Home. So now home means what here? Our company. Our company now. Our company. So in this case, ladies and gentlemen, what you will do is to gear. You gear up the above beta using our company's debt to equity ratio. Using our company's debt to equity ratio. You gear up the above beta using our company's debt to equity ratio. So again, remember it's Hamada's. It's Hamada's in play. So we have here 𝗲 equals 𝗲 into 1 plus debt over equity into 1 minus tax like that. So which 𝗲 are we gearing up? It is the one that we found here. It's the one that we are gearing up. We're increasing. So we have here 1.185 into 1 plus. Do we have our company's debt to equity value? Do we have our company's debt to equity value? Thanks, Hilda. Debt to equity value. Hilda has been able to confirm this figure. Do we have our company's? This question. Do we have our company's debt to equity ratio? Our company's. 𝗲𝗲 is our company. 𝗲𝗲 Limited debt to equity ratio by market value is 2:5. So it is 2/5. 2/5 times 1 minus t. Already we have this as 0.7 like that. Already we have that. So Alango is giving me 2:3. Alango ametoa 2:3 wapi? Hebu tuona Alango ametoa 2:3 wapi? Alango ametoa 2:3 wapi? Alango mimi kama ni 2:5. Alango 2:5. Maybe great. He's been able to correct misprint. Yes. Thank you very much. So Alango sasa unakuja hapo unasema hiyo 1.185. Unasema times no open bracket. Unasema 1 plus 2 divided by 5. Times 0.7, you close bracket. What are we getting there? In this case here, we have 1.5168. 1.5168. Nancy is confirming the same. 1.5168. So is that correct up to here? Now remember, everything is home now. Everything is home. Now we are not going away again. We're not going to make reference to the old company, to the new company. Now everything is home. Now after this, now after I've gotten the 𝗲, now the third step is for you to calculate, use qphem. So step number 3, use qphem to calculate our cost of equity of a levered firm. Please use the word our so they can own up the company. It's like your company. So use qphem to calculate our cost of equity of a levered firm. So is there somebody who is able to remember? qpem's formula? Do we have anybody who is able to remember qpem's formula? qpem's formula. Anybody who can remember qpem's formula? Qpem, like football. At least Onderi is able to remember something. Thank you very much, Rosemary. Thank you very much. So wananiambia mwalimu KPM, I will never ever in this case here hesitate. This is the easiest. So that KPM cost of equity of a levered farm will be equal to, we start with the risk-free. Risk-free capital asset. The first capital asset you should have is, and this is where most of us go wrong. In our investments, land should never be the first investment. We should always start with government bonds. Risk-free. That's how people grow. You start with government bonds, treasury bills before you go to these other risky. So we always start with risk-free assets. So plus, in this case here, these other assets, which are in the market. So ERM minus risk-free. And then outside here, we have what here? Bell. Outside here, we have the bell. We have the bell. So the risk-free, ladies and gentlemen, that we have, do we have like any treasury bills rate in the question? Do we have any treasury bills rate in the question? Do we have any treasury bills rate in the question? Hilda is saying 10%. So it is 0.1 plus. Do we have any returns, market returns? Do we have any market returns given in the question? Market returns given in the question? 15. Nancy is telling me 15. So 0.15. Risk-free, again, I'm repeating risk-free is 0.1. Multiply this by the bell that you guys have given me, 1.51, 68 like that. I hope all of us are able to see this risk-free and we are able to see the returns from the market portfolio. They've told us there. They've told us there. They've told us the average return on the stock, market equity is 15. And they told us there in second paragraph, second line, second sentence, that the corporate debt, which is assumed to yield a return similar to treasury bills, have a rate which is 10%. Treasury bill rate is risk-free. Risk-free. So then somebody is able to give me a final answer here very fast. So Onderi is giving me 17.59%. 17.59%. So up to there, are we together? Up to here, or 17.58 Alango, that is still very good. So up to here, ladies and gentlemen, are we really together now? Are we together? Yes. Now, after that, the last step, please don't fika here, and then you start in this case, you're smiling. No. We have to take it a notch higher. The examiner wanted a cost of capital. The examiner wanted a cost of what here? Cost of capital. The examiner, they're telling me, Mwalimu, use 8. I don't know why. Use 8. I shall use 8. They wanted cost of capital. So this has to be the famous wakaka. This has to be the famous wakaka. And how do we get this wakaka? To get this wakaka, to get the wakaka, we know we shall take weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus tax like that. Remember, we are still using what here? Our debt to equity ratio. Our debt to equity ratio. Where debt is 2 and equity is 5. It is 2 to 5. So giving me 7 in total. Meaning that the weight of debt will be 2 over 7. Weight of debt. And the weight of equity will be 5 over 7. Like that. 5 over 7. So ladies and gentlemen, if I come and plug in up here, my wakaka will be weight of equity is 5 over 7. Cost of equity, you guys have given me this figure, 17.58%. Plus weight of debt, we have it here, 2 over 7. Times cost of debt. Are you able to see the cost of debt, ladies and gentlemen? Are you able to see the cost of debt? Cost of debt. Remember, in most cases, cost of debt is equal to risk-free because debt is normally secured. Are you able to see the cost of debt really? Are you able to see the cost of debt really? These guys are not talking to me very well today. We wrote it somewhere. Treasury bills, treasury bond rate. We have it somewhere. Are you able to remember the 10%? So in this case here, 10%. 10%, 1 minus tax is 0.7 like that. 1 minus tax is 0.7. That is what you are required to do in that question pretty fast. That is what you are required to do in that question. So what are we getting at the end of the day? What are we getting at the end of the day? Onderi is giving me 14.5. I don't know who else is getting 14.5. I don't know who else is getting 14.5. I don't know who else is getting 14.5. 14.51 from Hilda. From Hilda, 14.51. So, ladies and gentlemen, does that now concept make some sense? Does it make some sense now? This concept here, does it make some sense? Does it make some sense now? All right. So then if you allow Mwalimu will be able to provide some guidance over this question that was tested in April 2022. April 2022. April 2022. April 2022. April 2022. So we have here April 2022. April 2022. April 2022. Question number 1B. Question number 1B. So in this case here, once you get it, please put your thumbs up like this and smile. You must always smile. Put your thumbs up like this and smile. April 2022, question number 1B. I just want to provide some guidance. April 2022, question number 1B. Paul already has it. Paul already has it. Is it possible for somebody to share this document in the group, please? In this SPR or AFM group. SPR AFM group, please share there. Please share there. Thanks, Nancy. Nancy, you're always on top of the game. That's what I want. Even if you're not understanding, if you want to be on top of the game, always ask questions. Always ask questions. Leonida also is among those guys who are on top of the game. So we are told there, I believe somebody has been able to share this on the group. We are told here, Dansof Limited is a Jewish processing firm which is solely equity financed. The company's board of directors are considering diversifying the operations by entering into the soda processing industry. So they are going to a new market. Hamada's model will be used. Paul, thank you very much. That's very good of you. Paul has shared the document here. So they are going into a new industry. So Hamada's model must be used. Additional information. The current unlevered equity beta is 1.4 for Dansof Limited and 1.5 for the soda processing industry, respectively. The gearing in the soda processing industry is on average 40%. Hence, the capital structure is 40% debt and 60% equity. Remember, gearing is debt. In most cases, people will not give you the sentence that comes up after that 40%. Somebody will tell you the gearing is 40%, is you to figure out if gearing is 40%, then equity must be 60%. That will be your work. The return on market portfolio is 15%. They're giving me RM there. RM is 15%. The risk-free rate is 12%. 5. Debt finance is considered to be risk-free. 6. The Hamada's model should be used to determine the levered equity beta. 7. The cost of equity will be determined using CAPM. 8. Corporation tax rate is 30%. So they want me to recommend the suitable discounting rate for the new investment if the directors were to use 20, 80%, 50, 50% equity. These are free marks, 100% free marks. I'll get them without even sweating at all. But before I do the question, I would want somebody in this case here to get me started. Just get me started. Get me started. Tell me where am I going to knock this question from? The belly or wherever? Chest. I mean, I need to know how to punch in this thing. Get Bell. Get Bell. Are you sure? Are you sure, Paul? If I were you, I would remember the steps. It's the away match, isn't it? Even if you're telling me it's Bell or whatever, I know the first step is new industry, new industry, new industry, new beta, and the new, in this case here, new debt equity ratio. And then, of course, what will I'll not get Bell, I'll get BEU. I'll get BEU, beta equity of unlevered farm of the new industry. But I know what you guys are implying. But Mwalimu here, then you need to come and use the Hamada's model. So Bell equals BEU into 1 plus debt over equity into 1 minus T. Now, could you kindly do me a favor? Could you kindly do me a favor? Are you able to see the new beta? The new beta. That is a beta of the new industry. Beta of the new industry. Beta of the new industry. Bit of the new industry, are you able to see it? The soda processing. the soda processing. Nancy, 1.5. Leslie, 1.5. Thank you very much. So in this case here, this new beta is 1.5. And remember, this is Bell. This is Bell. The new beta for the new industry, that is a new industry, for the new industry, which is soda for us, the one you get there is your Bell. And is there somebody who can give me the debt to equity ratio of new industry, of soda, new industry? Is there somebody who can give me this for the new industry? Is there somebody who can give me this? Is there somebody who can give me this for the new industry? 2080, 4060. I don't know who is telling me the truth. I don't know who is cheating. I think here it's Nancy who is cheating, because 2080 is a figure for directors. That is our debt to equity. That is our debt to equity. So let's leave Beu, yes, 1.5. Oh, Bell or Beu. Oh, the 1.5 you guys have gotten. Is it Bell or Beu? Is it Bell or Beu? Thank you very much for asking that question. That's very good. That's very good of you. That is very good of you. That's very good of you. Let's read again here. We are told here, the current unlevered equity beta is 1.4 for Dansoft Limited and 1.5 for the soda processing industry, respectively. The gearing in the soda processing industry is on average 40%. Hence, the capital structure comprises 40% debt and 60% equity. The return on the market portfolio is 15. The risk-free rate is 12. The debt finance is considered to be risk-free. The Hamada model should be used. Thank you very much. I can see up there is no confusion. They have told me the current unlevered equity beta is 1.4 for Danson and 1.5 for the soda processing industry. So you guys are right. So in this case here, ladies and gentlemen, we have been given Beu directly. We have been given, in this case here, Beu of the new industry. So Beu of the new industry has been given. Beu of new industry. Thank you very much. Of the new industry. So nimesoma vizuri hapo. Of new industry has been given as 1.5. So all these steps are what here? They are irrelevant. Cancel them as you curse me. Cancel them as you curse me. Beu of the new industry has been given. So there is nothing like ungearing. So that step of ungearing is away now, is out of our way. Is out of our way. Because we normally go through this step to get Beu. So Beu for the new industry, that has been given. Then straight away, the moment I know that, then I'll go now back home. So let's get back home. Let's get back home. Let's get back home. Let's get back home here. Now we come back to our company. Our company. So get, in this case here, Bell for our company here. So then how do we get this Bell for our company? Remember, you're using the above Beu. So Bell then will be equal to, it is Beu into 1 plus debt over equity into 1 minus what here, somebody? 1 minus tax. So remember now here we are on the home stretch. Home stretch. The only thing we are borrowing from above is this Beu. So then this Beu will be 1.5 times. Do we have 1 plus? Do we have the debt to equity? Do we have our debt to equity ratio? Do we have our debt to equity ratio? Abracadabra. Abracadabra. Do we have it? Tell me the figure. Tell me the figure. Debt to equity ratio. 40-60. They're giving me 40-60. Debt to equity ratio. Do we have it? 2 to 3. 2 to 3. Wanasema 2 to 3. The gearing in the soda processing industry is on average 40%. Hence, the capital structure is 40% debt, 60%. Remember, that is for what year? That is for the new company. Now we are out of the new company now. Now we are at home here. Our company. Our company, abracadabra, where are we? Our company. Our company. So I'm going to remain silent a little bit to see whether there is somebody who can pick it. I already can see Hilda's picked it. Our company. Our company. Abracadabra, our company. Remember, I would have used that 2:3. That 40:60. I would have used it up here. But you see, this step now is unnecessary because already we are given bill of the new company. All right. All right. Ladies and gentlemen, remember this examiner was a tricky one. For Roman 1. Look at Roman 1. We are doing now Roman 1 here. For Roman 1, they have told us, recommend a suitable discount rate for the new investment if the directors were to finance the new project, now our project here, using 20% and what here, somebody? 80% equity. 20% and 80% equity. So that is our own. It's our own project here. So we have here debt is 20%, equity is 80%. Equity is 80%. So then, ladies and gentlemen, if that is the case, this is what I will use here. So we have bill of 1.5 times open brackets 1 plus debt is 20% over equity of 80%. 1 minus tax, already we have this figure because tax is 30%. Tax is 30%. So then using your, of course, the percentages they will cancel out. Using your calculators, what are you able to get for our bill? What are you able to get for our bill? According to Nancy, it is 1.7625. 1.7625. Is that okay? 1.7625. Somebody else confirm this figure very fast. 1.765. Hilda has been able to confirm the same. So then, having gotten this still on Roman 1, what do you think will be the next thing for us to do? What do you think will be the next thing for us to do? I know it's a bit tricky, but you'll understand, all of you. As we get along, you'll understand. What do you think qphem is? So apply qphem now. So in this case here, apply qphem. So go ahead and give us kel. Our kel. We call it our kel. Our kel. So our kel, is there somebody who can be able to give us this kel here? qphem, get the cost of equity using qphem. Our kel. So the kel that we have, this is the kel that we have. Yeah. This is the kel that we have. So step number 3, kel using qphem model. So we know that this is risk-free plus ERM minus risk-free multiplied by the bell that you guys got up there. So as the examiner given me the risk-free rate here, risk-free rate of return, has the examiner given me the risk-free rate of return? What percentage? What percentage risk-free from the question? 12%, they're telling me 12%. So 0.12. Do we have in this case here expected returns of the market? Do we have expected returns of the market? 15%. So we have here 0.15 minus this 0.12. And we happen to be having this bell of 1.625 like that. Then at the end of the day, what will be our kel? At the end of the day, what will be our kel? So kel, they're giving me 17.29. 17.29%. Bonalango, I'm not seeing you in figures totally. I don't know whether we are together. I don't want to lose anybody. Yesterday, I lost some of you. We are going to target like 6 or 7 areas for this exam, and we are not going to rush. No. We shall not rush. I agree, we should not rush. Everybody should be able to understand. So Alango, today, are we okay somehow? All right. So then what do you think will be the last step after getting this scale? Because they wanted us to give them the suitable discounting rate. It's wakaka, yes. So they want us to give them wakaka. So wakaka, we know that this is weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus tax. And remember, it is our weight. It's still our company here. Fortunately, they have told us debt is 20%. Debt is 20%, and equity is 80%. Debt is 20%, and equity is 80%. So out of this, are you able to see the weight of debt? 0.2, isn't it? Weight of debt. This is very obvious. So weight of debt is 0.2, and the weight of equity is 0.8. And therefore, our wakaka will be equal to weight of equity 0.8 times CAL that you got here, 17.29%, plus 0.2, which is weight of debt, times cost of debt. Anybody who is able to see the cost of debt in this question? Remember, when cost of debt is not given, it shall always be taken to be the risk-free, because debt is secured. Risk-free, yes. Thanks, Lodida. Risk-free. Risk-free. So, and the risk-free rate is 12%, times 1 minus tax, which is 0.7, which is 0.7, which is 0.7, which is 0.7. 15.51. 15.51%. So I don't know whether all of us we are able to get this 15.51. 15.51. Are we able to get this 15.51? All of us. It should be all of us, really. It should be all of us, really. It should be all of us. It should be all of us. Thank you so much. Thank you so much. And then we go to Roman 2. So Roman 2, our capital structure is changing to 50-50. Roman 2, our capital structure is changing to 50-50. Roman 2, 50-50%, 50-50. So debt 50%, equity 50%. So we start right away from away. So, and away is to use Hamada's model to find the BEU of the new industry. This will not change because the capital structure has changed. So BEU for the new industry will remain what we had up there, which was how much? This was given to us directly. BEU, this is 1.5. Thank you so much. We come home. So home, give us the BEL of our company. BEL of our company. So BEL here will be equal to BEU into 1 plus debt over equity into 1 minus tax. So already we have the BEU, which is 1.5 into 1 plus debt over equity. Debt over equity here, what are we looking at? What is debt? What is equity? Remember, this has to be our. Don't use the one of the new company, the new industry. Now here we are owning up everything. We only use new industry information on this away. On this away. So it's 50-50. Thank you very much, Hilda. It's 50-50. 50 over 50. 50% over 50%. Times 1 minus tax, which is 0.7, like that. Times 1 minus tax, which is 0.7, like that. Or 1 to 1, if you wish, you can talk of 1 over 1. The same. So according to Hilda, she's getting according to Nancy, 2.55. Someone else who is able to confirm 2.55. Queen Magdalene, 2.55. 2.55. Sasa nyinyi mmekuwa kamenywa juaji. After getting this home BEL, this will give birth to home what here? Home CAL. CAL. So go ahead and give us the CAL. CAL, always use a pen, which is risk-free plus ERM minus risk-free multiplied by the BEL that you guys got up here. BEL that you guys got up here. So in that case here, then our CAL will be equal to risk-free. Risk-free, we have it. It will not change. Risk-free is 0.12 plus ERM, returns of the market, is 0.15 minus risk-free, which is 0.12 multiplied by BEL, which is what we have obtained it. It is 2.55. So is there somebody who is able to give me this figure pretty fast? So according to Hilda, it's 19.65. It is 19.65%. 19.65%. Rosemary has also confirmed. Esther Mtinda has confirmed. Gentlemen, today you guys are quite, silent. I don't know why. Onderi at least has been able to get it. So after CAL, of course, we come to the mother of them all, what we call Wakaka. Wakaka. And Wakaka, we know is weight of equity, cost of equity, weight of debt, cost of debt, after taxation, like that. So in this case, remember, equity is 50% and debt is 50%. So weight of equity will be 0.5 times the CAL that you have, 19.65%, plus weight of debt, 0.5 times KD, you guys gave me 0.12, which is 12%, times 0.7, which will end up giving me what figure, ladies and gentlemen? Which will end up giving me what figure, ladies and gentlemen? 14 point something, isn't it? 14 point something. So, ladies and gentlemen, this is one of the areas that I would want us to time, this one here, in your exam. So ensure that you watch the two videos, yesterday's video and today's video, to even get more understanding. And then we have a very good ACCA book, which I would want to share with you guys, which your examiner in this case is really picking questions from. He's really picking so many questions from here. And it has very good answers. Very good answers. I would want you to take advantage of this book so much. All right. So like there is this questionnaire that they have been able to do very well. Like when the project is financed 40% and 60% equity, when the project is financed 20%, these guys, CASNEP guys, we lift questions a lot from this ACCA book. So I'll be able to share this book with you. It is the book that I shall be using for revision. Very, very important book. But to sum up our today's lesson, I would want us to look at another question here, still on yeah, the one that came in most recent. I can't see it. It must be on my. Just a minute. So December 2023, question number 1B. December 2023, question number 1B. December 2023, question number 1, boy. December 2023, question number 1, boy. Once you get it, are you able to shoot up your hand? Great, they've gotten it already. Great. December 2023, question number 1, boy. December 2023, question number 1, boy. So we are told there, in a study carried out by a financial analyst, the earnings before interest and tax of Papa Limited and 𝗖𝗀 Limited were found to be 10 million. Somebody should be able to share with Moses, please. Somebody should be able to share this question with Moses. Somebody, please. Papa Limited is fully equity financed, while 𝗖𝗀 Limited is financed partly using equity and debt. The capital structure of both firms are given as follows. Both firms adopt a 100% payout ratio as their dividend policy. And then we are told the cost of equity of Papa, the one that is all equity financed, is 10%. Using Modigliani and Miller proposition in the absence of taxes, determine the cost of equity of 𝗖𝗀 Limited. Now, ladies and gentlemen, the very first thing that I will do if I get this kind of a question, who is 𝗖𝗀? I know that Papa is all equity financed. So Papa hana deni, Papa is all equity financed. All equity financed. And then we have 𝗖𝗀. 𝗖𝗀 in this case he has got debt. So it's debt plus what here plus equity. So when they tell me to come and give them the cost of equity of 𝗖𝗀, then this is the cost of equity, ladies and gentlemen, of a levered organization. And here, ladies and gentlemen, I'm not going to use, I can't use a 𝗕𝗵𝘆 here now. Because you can see the kind of information given here really does not support 𝗕𝗵𝘆. You don't have like risk-free language like that. So then I know the other formula. I know that KL is also obtained by us taking KU into KU minus KD into debt over what here? Equity. Debt over equity into 1 minus tax. So this one here does not have what here? Does not have tax. Doesn't have tax. Does not have tax. This doesn't have tax at all. This does not have tax at all. Now, ladies and gentlemen, the other thing you're supposed to know. Okay, first of all, are we together regarding this formula? This is a very important formula. I showed you yesterday this formula. I showed you yesterday this pretty great formula yesterday. If you can remember, KL equals KU. KU is cost of equity unlevered. KU, cost of equity unlevered. All right. Yes. Thank you very much. Now, there is no way you will be able to get this cost of equity unlevered without farm valuation. We have to know the farm value. We must know the farm value. We must know the farm value. And how do we get to know the farm value? To get to know the farm value, remember under MMM1, value of unlevered equals value of levered. Under MM1, value of kaka will be equal to value of who? Value of papa. So then let's go ahead and value the unlevered. Remember, we started by valuing the unlevered farm. So how do we value this unlevered farm in the next 5 minutes? To value this unlevered farm, this is what I will do. Very easy, really. I know, and I told you from our yesterday's class, ladies and gentlemen, we know that value of unlevered farm, I'm looking at profit after tax, I capitalize. I'm looking at profit after tax, that is my income. And then one of the assumptions is that this organization will stay with us forever, indefinitely, perpetuity, amount over R. The amount here will be profit after tax, remember. All over R in this case here, which is what here, which is our cost of equity. So, and how do we get this part? To get part, if you can recall our argument, we must always start with EBIT minus interest. And then we come and levy taxes. We levy taxes all over cost of what here? All over cost of equity. But now remember, under MM1, we don't have tax. And if it's unlevered, do we have interest? No, we don't have interest if the farm is unlevered. But for me, I discovered, and this is something I discovered after practice, I discovered I would rather always write these formulas like this, and then I can plug in whatever now the examiner gives me. Like in this particular case, ladies and gentlemen, my value of unlevered will be equal to the EBIT has been given, right? EBIT has been given in this question. What is the EBIT? EBIT is 10 million. Are you able to see 10 million? EBIT is 10 million. So because it's unlevered, then interest is 0. I will not levy any tax because tax is 0 there. Tax is 0 there. So have they given me the cost of equity of this unlevered farm? Remember, the unlevered farm is papa. The unlevered farm is papa. So, ladies and gentlemen, the unlevered farm being papa, the cost of equity I can see from note number 2. From note number 2, the cost of equity of papa is 10%. The cost of equity of papa is 10%. So then are you able to give me this value of this unlevered farm? Is there somebody who is able to give me the value of this unlevered farm? Is 100. So in this case, Leonida is telling me it's 100. All of them, they are getting 100. All of them are getting 100. So, and remember, this is the value of papa, unlevered. So value of papa is 100 million, And therefore, value of kaka will be 100 million as well, because this is MM1. MM1, the two organizations should always be having equal values. MM1, the two farms should be having equal values, And the moment I've been able to get this value of kaka, which is the same as value of a levered farm, which is 100, we said in our yesterday's class that you must go ahead and expand this to debt and what here, somebody? Equity. We must go ahead and expand this to debt and equity. Is there somebody who is able to see the debt of this organization? Is there somebody who is able to see the debt of this organization? Is there anybody who is able to see the debt? Is there anybody who is able to see the debt of this organization? From the table given, there's a table given there. There's a 5% debt, which is 50. So if debt is 50, and you're telling me that the value of the farm must be 100, then what is this equity component? What is this equity component? It will be 50, yes, because the two must add up to the same. It will be 50. It will be 50. And once I've now done this farm valuation, now I can go back to my cost of equity of a levered organization. So cost of equity of a levered organization will be equal to Q plus Q minus KD into D over E. Now you can even leave out the 1 minus tax, but just put it. I like putting them. I like putting them because I'll just say there. Here, I think it's 100. Sorry, Paul, read, Paul, if you go to paragraph number 1. In a study carried out by a financial analyst, the earnings before interest and tax, EBIT, of Papa Limited and Kaka Limited was found to be 10 million. Paul, look at that 10 million very well. It's given there. Don't confuse in this case here. Don't confuse in this case here EBIT with. Paul, are you able to see it? Because you're confusing EBIT with with equity. So then in this case here, do we have cost of equity of unlevered farm? Do we have it? Cost of equity of the unlevered farm, cost of equity of the unlevered farm, do we have it? Oi, time is up. Do we have it? It's 10%. Is it 10% or, yeah, it's 10%. So 0.1 plus 0.1 minus KD, cost of debt, the debt instrument given there is 5%. Oh yeah, debt instrument given there is 10%, 5%, 0.05. Debt, you've given me debt of 50 and equity of 50. Debt is 50, equity is 50. And then now we have here 1 minus 0, like that. So are you able to give me the final answer? Are you able to give me the final answer? Are you able to give me the final answer here? Are you able to give me the final answer? Are you able to give me the final answer? The final answer, somebody. Because number 1, they wanted us to give them cost of Papa. I'll be able to show you another formula, but this is what I would want you guys to really do what here? To really master. To really master. So they're giving me 25%. They're giving me 25%. They're giving me 25%. 25%. They're giving me 25% here. So 0.1 minus 0.05. Use your calculator as well. Use your calculator as well. Use your calculator as well. So we have here 0.1 minus 0.05. 0.1 minus 0.05. I'm getting, in this case here, 0.05. 0.05. I hope this is not confusing you 50-50. Whatever we get here plus 0.1. I'm getting, in this case here, ladies and gentlemen, 0.15. I'm getting 0.15. I'm getting KEL as 0.15, 15%. Please always use body mass, brackets first. Because you see this 50 and the 50 will give me 1. So when I take this minus this will give me 0.05 plus this 0.1 will give me 0.15. So 15% is the correct answer. 50% is the correct answer. So when I come in my tomorrow's class, I'll be able to showcase to you guys how do we deal with Roman 2 and Roman 3, which wanted me to work with arbitrage profits. So what is your take? Are we making progress with our revision? We have come to the end of this session, but are we making some progress? Are we making some progress? Great, great. We shall make lots of progress, lots of progress. We are overcoming, yes, you'll be surprised. And once we have captured very well this advanced financing decision, and then we go to international finance, you'll thank me, all of you. You'll be very happy. Thank you so much, and preach that good gospel in the groups. What was 𝗖𝗹𝘀𝘀𝗀𝗀 sana? This different program. Nobody paid to be taught over lunch hour. Thank you. Good afternoon. Bye.